Hey guys, in this video, we're going to discuss what is a disregarded LLC versus a partnership LLC for real estate investors. Okay, let's get started. Okay, disregarded LLC, partnership LLC, what are we getting at here? Well, first thing you have to understand is that a limited liability company, it's what we would call a hybrid entity from federal tax purposes. And what that means, and typically people get confused on this, is that when you're setting up a limited liability company, you're going to set it up first with the Secretary of State of the state where you want to get it going. So if I wanted to set up a Florida limited liability company, I'm going to set it up in Florida, tell them if it's member managed or manager managed, and file my articles. And then after my LLC is set up, that's when I'm going to come down and contact the IRS. So I got this LLC here. I'm going to reach out to the IRS and say, hey, I need an EIN number. And so I'm going to fill out what is referred to as an SS4 to obtain my employer identification number for this business entity. Now, when you're filling it out, because it's an LLC, we have more than this, but typically it's 4 options. You can have it taxed as a C Corp, S Corp, partnership. All right, we're going to talk about that. Or it can be a disregarded entity. All right. Now, so what does that mean when I say it's disregarded? Well, what we're getting at there is, number one, it only has one owner. So the entity we're creating, this LLC, there's only going to be one owner in this entity. Now that could be me. I could be the owner. It could be a Wyoming LLC. As you know, I like to always use this Wyoming LLC down here as the owner of a state-specific LLC for anonymity and asset protection. So that could be the one owner of that limited liability company, but it's not going to be 2. In limited circumstances, if it's a husband or if it's a married couple in a community property state, you could do it. But for the most part, it's going to be one individual or one entity. So if I set it up and I choose it to be a disregarded LLC because there's only one owner, what does that mean to the IRS? Well, what it means is this, that whatever you have inside of here, let's say we transfer a piece of real estate into the LLC, the IRS is not going to look at the LLC for any type of tax return. It's not even going to treat the LLC if it owns the property. From a tax standpoint, the IRS is going to look at the LLC and say, it doesn't exist. This asset is really owned by this individual right here for tax purposes. Now, this has nothing to do with asset protection, and so many people confuse that. They think, well, if I have a disregarded LLC and someone sues, they're going to go right through the LLC and sue me. Your tax status for the LLC has nothing to do with the protections it provides you. Don't even worry about that. So when I have a disregarded LLC, if this property generated for me $20,000 in income, that's going to show up on my 1040. In fact, I get this question a lot. A real estate investor will contact me. They have 5 properties. They need to create 5 limited liability companies, and they want them set up as disregarded LLCs. And they say, what's going to happen to my taxes? Nothing. What do you mean nothing? Well, what did you do last year on your return? Because this year you're going to do the exact same thing. They'll say, well, I set up an LLC. I said, I know it doesn't matter because the LLC is disregarded. You don't have to file anything, right? Just keep filling out your taxes the same way you've been doing it and everything will be fine. And people often wonder, well, do I have asset protection? Sure you do, because you don't own the property from a legal standpoint, but from a tax standpoint, you're treated as the owner. Hence the word disregarded. Now, should you use disregarded LLCs? Absolutely. I think they're great. If you can set up an LLC and make it a disregarded entity, you ought to consider doing that in many situations. But who is going to be that member in the LLC is the question. That's when we start looking at partnership LLCs now at this point in the game. See, with a partnership LLC, if you want to elect partnership tax status, what you're going to have to do is bring on someone else. So, for instance, if I created my Wyoming LLC down here, this is my Wyoming, and it's going to own all of my state-specific LLCs, 1, 2, 3, like that. All of these LLCs are going to be owned 100% by this one Wyoming LLC. So all of these, I'm just going to put a D inside of them. This means they're disregarded. So they don't have to file any federal tax returns. So if they're not filing any federal tax returns, where's the income going? Who's reporting it? Well, you have a couple options. If I create this Wyoming LLC and I'm the sole owner of it, then because I'm the only owner, the only option I have is disregarded. I mean, you could go S or C Corp, but you don't want to do that. So really your only option is disregarded status. So it would all flow through this Wyoming LLC, come down to you and show up on your 1040 Schedule E, page 1. Again, your tax return would not change. But if you want to bring someone else into your investing with you, like a spouse, all right, now you can no longer elect disregarded status here, because how many people do we have involved? We have 2. It doesn't even need to be a spouse. Maybe you're not married, you don't have a spouse. Well, it could be another entity that you have. You can make your entity your partner, give it a 1% interest, and now there you go. You got a partnership. Partnership requires a minimum of 2 partners. You can have more, but the minimum is going to be 2. So now if I have 2 people here, when I apply for my EIN number, I'm going to elect partnership tax status for this LLC because it has 2 members. It's no longer eligible to be a disregarded entity. So now because it's going to be a partnership down here, that means it has to file a tax return, which is a 1065. Okay, now the 1065 that you file, that's okay. It's still pass through, but it doesn't hit your return the same way. You see, if this was all disregarded, as I showed you earlier, it all flows down onto your 1040. Well, when you make this a partnership now, what's going to happen is this is all going to flow down to here, and it's going to get calculated out on the partnership's tax return. There's no taxes that you have to pay at the LLC, by the way. With a partnership return, it's just informational. All it's going to do is take it all in, mix it all up, and then spit it out and say, this is how much this partner owes in taxes. This is how much this partner will owe in taxes. So if I had 2 partners here, both of these individuals were 50-50. Because they're married and they filed jointly, it's going to show up on their joint tax return via K1. And what's going to happen is this 1065 is going to give them a K1. And I got a video on what is a K1, a short video if you're not familiar with it. And so now it's going to show up in your 1040. And because it's real estate, it's going to show up on your Schedule E. Schedule E. But what's different now is that where these were disregarded and they filled out on page 1, you know this. If you look at your 1040, you know that you see your Schedule E and has all your properties listed there. Maybe you have multiple pages. Now what happens, this shows up on the back side of that page, which is what we refer to as page 2. And so you take this K1 you got and you take the information off of it and you put it on your Schedule E, page 2. So why do all of this when you're setting the entities up? Well, it comes down to this. By setting these up as disregarded entities in this overall structure, I'm saving myself on having to prepare a bunch of tax returns and make my life complicated and pay a CPA. Now, why wouldn't I make this one a disregarded entity? Why did I make it a partnership? Because I think there's some compelling reasons to keep this as a partnership, as a buffer between you and your real estate. And namely, that comes down to the fact that audits, fewer audits on 1065s than 1040s, all right? So that's what I want to do. I want to minimize the risk of audit on the stuff that's going on in this jumbled mess over here. Another reason why I'm going to want that K1 or that 1065 and give me the K1, it's when I'm working with Freddie, Fannie lenders, how they evaluate the income from my rental properties, that I want to make sure I get a boost in my debt to income ratio. So that can be a benefit for you, to have that partnership return. Yes, it's an extra expense, but it provides certain types of benefits as you move forwards. A third benefit that can come from it is that as you move into different asset classes, you're going to look like you're a more experienced investor, because the more experienced investors invest through partnerships, entities that file tax returns, and they don't do it in their own name. Because if you were to turn over your tax return to someone and you had 35 LLCs all set up as disregarded, they wouldn't know that. They would think you're just investing in your own name. And if you said, hey, I'm real experienced, yeah, maybe you are, but from a business side, you don't appear to be that experienced, because that's not how people do it, or the experienced investors do it. So this gives you a little, I think, a boost there in credibility when you're telling someone, yes, I'm experienced, if they look at your tax returns. So I do like the partnership for those 3 reasons between you and your entities. Now, I get this question all the time. What if I only have one property? Well, if you only have one property, you can just make this one a disregarded entity and bring it right down onto your return, because you can always change it at a later date. As you start to acquire more, you can take this disregarded entity and elect to treat it as a partnership, say 3 years from now or 2 years from now. Only thing you would have to do though is bring in a second partner into that limited liability company to elect that status. So as you see, for real estate investors, there's no problem with disregarded entities. It doesn't impair your asset protection at all. It's only a tax election. And really, it's just an identification number so you can get a bank account opened up. Because other than that, you really don't even need an EIN for an LLC that's disregarded. But if you sell the property, of course, it's held in the name. The title company is going to want to have all that information. So you just go and get it. Anyways, I hope this makes sense when you're choosing disregarded status, what it means for real estate investors and their limited liability companies versus partnerships. Guys, got any comments? Leave them down below, or questions as well. Make sure I get to those. And you got any ideas for other video topics you'd like me to talk about? Be sure to send those to me. I truly appreciate anything that I get from you all. All right, take care.